Welcome, everybody, to Let's Talk About It, where each week we talk about a different topic and how it affects the Black community economically. And this week we're going to be talking about the top 10 cryptos and the difference between how institutions invest versus how retail investors invest. But as always, to start it off, we're going to start with our disclaimer. The information provided is strictly for educational purposes only. We strongly encourage you to consult with licensed financial advisors before making any significant financial decisions or investments. Though I do have decades of experience, I am not licensed or registered with any regulatory authority. And now we're going to jump into the introduction video. Let me share my sound, and then we'll jump right into the presentation, then the discussion.
Have you ever wondered how the big players, the institutions, actually look at crypto? Well, today we're pulling back the curtain. We're going to dive into the exact playbook the pros use when they're analyzing the biggest assets in the market. Let's get right into it. Okay, let's start with a number that might be a little tough to swallow, 5 to 15%. What is that? Well, according to a whole bunch of market data, that's roughly how much retail investors underperform the market year after year. That is a huge gap, and believe me, it is not just bad luck. Which, leads you to this very simple question. What do they know that you don't? What is the secret advantage these institutions with whole teams of analysts have? That's what we're going to unpack right now. And that's our whole goal here, really. We're going to try and bridge that knowledge gap. The idea is to give you the same kind of analytical lens the professionals use, so you can start to shift your mindset from a purely retail one to an institutional one. Now, here's the most important part to understand. It's not that they have some kind of secret insider tip line. It's much simpler and, frankly, more powerful than that. They're just using a fundamentally different playbook. Same game, totally different set of rules. So, let's actually put these two playbooks head to head. I think once you see the common pitfalls of the average retail approach right next to the disciplined strategy of the pros, it becomes crystal clear why their results are worlds apart. And this just lays it all out, doesn't it? On one side, you've got the retail approach. It's often really reactive, chasing the latest hype on social media, making trades based on fear or greed. Let's be honest, it's basically gambling. But then you look at the institutional side. It's methodical. It's driven by cold, hard data. It's focused on the long haul, and they are absolutely obsessed with managing risk while they patiently accumulate. Two different worlds. Okay, so how do they actually put that discipline into practice? Well, it all starts with a really rigorous checklist. Before an institution even thinks about allocating a single dollar, any potential crypto asset has to pass this 5-point inspection. And here it is. First up, liquidity depth. Can they get in and out of a big position without wrecking the price? Second, regulatory clarity. Is the legal stuff sorted out? Third, network stability. Is the blockchain battle-tested and secure? Fourth, developer activity. Are smart people actually building useful things on it? And last but not least, custody solutions. Can they store this thing safely, with insurance and all that? You see the common thread here, right? Every single point is about killing risk. Let's just zoom in on that first one for a second. Liquidity depth, because for big money, this is a total deal breaker. All it means is that there's a deep pool of buyers and sellers available. So an institution can invest, say, $10 million without their own trade pushing the price way up. That effect is called slippage. If an asset isn't liquid, for them, it's a hard pass. Simple as that. And this really gets us to the absolute core of the institutional mindset, protecting capital. For a professional, not losing money is way, way more important than chasing some huge speculative gain. So how on earth do they manage risk in what is probably the most volatile asset class on the planet? Well, their entire risk strategy pretty much rests on these 4 pillars. First, diversification. Pretty straightforward, right? Don't put all your eggs in one basket. Then, hedging strategies, which are basically like insurance policies against a market crash. Third, on-chain monitoring to see what's actually happening on the network in real time. And all of this is guided by the number one rule: capital preservation. Rule 1, don't lose money. Rule 2, don't forget Rule 1. Now, that word hedging can sound really complex, but I want you to just think of it as portfolio insurance. That's all it is.
Um,
Institutions use financial tools like options to protect their main investments from a big price drop. This lets them hold on to their long-term positions through all the crazy volatility without ever having to panic sell. And this is one of the coolest, most unique things about crypto. On-chain metrics are data pulled right from the public blockchain itself. We're talking active addresses, transaction volume, network value. It's a completely transparent, real-time report card on a network's health and its actual usage. It's kind of like getting a company's real user data every single minute instead of waiting for some polished quarterly report. It's a game changer. So, with all that in mind, when institutions look at the top crypto assets, they're not just seeing a list of coins to bet on. As you can see here, they're building a portfolio where every single asset has a specific job. You've got your core store value, your digital gold, like Bitcoin. You've got your foundational tech platform, like Ethereum. You need payment solutions like XRP. And of course, you need the essential plumbing of the market, which is stablecoins. It's all about building a system where each part complements the others. All right, so this brings us to what's probably the most important part of all of this. How can you take everything we've just talked about and actually start applying this professional playbook to your own strategy? It really comes down to asking a few key questions. First, focus on utility. Does this project actually solve a real problem for real people? Second, check out the governance. Who's in charge here, and is the decision-making process transparent? Third, look at partnerships. Are legitimate companies actually using this tech or building with it? And finally, analyze the ecosystem. Is there a healthy, growing community of developers and users? And for that last point, one of the best metrics out there is TVL, or total value locked. It's basically the total amount of money that people have deposited into all the applications on a blockchain. You can think of it as a direct measure of the size of the economy running on that network. When you see a rising TVL, that's a really powerful signal of growing trust and adoption. So after seeing the institutional playbook, with its focus on data, on risk management, on long-term fundamentals, I'll just leave you with this one question to think about. When you look at your own strategy, honestly, are you investing or are you gambling? The answer to that could change absolutely everything.
all right. So let's jump straight into the presentation. It's not going to be a long one. The video really did a good job on covering the overall topic on what institutions know that retail investors don't. And we're going to be looking at the top 10 cryptos. Um, so this is all about bridging the knowledge gap, right? The information is out there. We live in the information age. And so it's about doing your due diligence and setting up strict parameters when it comes to investing and versus most retail investors where they're going off of sentiment or just chasing what the latest fad is. So data-driven analysis is probably the most fundamental difference between institutional investments and retail investors. And in this day and age, there's really no excuse for a retail investor not to do the same level of detail analysis that the big institutions do. The data is out there, it's available, and especially now with AI, it's easy to set up the tools to perform the analysis. And then there's long-term positioning. So there's a difference between trading and investing, right? So With the institutional money, the majority of it is coming in. They're taking long-term positions. It's a small percentage of their portfolio balance, but they're in it for the long run, and they are mainly investing through ETFs. Then there's the risk management, and this is where hedging comes into play, especially options, futures, perpetual options, as well as just your typical, stop loss trades. Um, and so, it's more important not to lose money than to make a lot of money, because once you've lost money, you don't have the opportunity to make any more money. And so, the BNIC network prides itself on being risk managers first and foremost. And so this is one of the reasons why we're having this discussion about how institutions invest, because we've seen billions of dollars of institutional money come into the crypto industry. First, it was focused on Bitcoin through the ETFs, and then it was ETH, but now we see it spreading to other, what they call altcoins, but they're still managing their risk. And so you can use the exact same management techniques that the institutions use. And then there's strategic accumulation. Dollar cost averaging is the easiest way to accumulate assets as a position in your portfolio. It's investing the same amount of money every time period, whether that's every paycheck, every week, every month, every quarter, but it's being consistent and not worried about the price, not timing the price high and low, because again, we're looking for long-term investments and we're looking for strategic accumulation. So here are the top 10 currencies as of market cap as of last week. And as we know, the crypto market is extremely volatile. On Friday, we had a significant pullback of about 10%, and that happened in about an hour. And so you can see those dramatic pullbacks, but then over this weekend, a lot of that has come back already. And so when you're in it for the long-term investing, those type of pullbacks should not concern you. But here are the top 10s, and here are the characteristics of the top 10. So Bitcoin, digital gold. We've talked about Bitcoin a lot here, so I'm not going to go into any real detail about it. Ethereum, though, that is the smart contract platform that is powering the NFTs. It's powering DeFi. It's the building blocks in crypto. XRP is the cross-border payment solution platform that many of the major financial institutions are using for building their back offices. Tether is the number one stable coin that's currently being traded, and it has the greatest liquidity. BNB has really been reborn, and there are lots of dApps applications that are being built on BNB, especially in the perpetual exchanges. And so you're seeing the use case for BNB increase dramatically, and that's what this is all about, is about the ecosystem growing. And when the ecosystem grows, the usage of the token also grows, and the value of the token grows. Solana has been on a tear, mainly for meme coins. But there's a lot of other developer activity that's happening on Solana. USDC by Circle is the first publicly traded regulated stable coin. And so it allows institutions to abide by all of the regulatory parameters set forth by the banking system in order to invest in stablecoins. Dogecoin is the ultimate meme coin, and it's has a huge ecosystem, and now that ecosystem is actually developing useful applications that actually have utility. Tron. Tron is actually one of the rails on which Tether is exchanged on and is built on. So Tron is helping build the backbone of the digital financial system. And then there's Cardano, research-driven blockchain, which rounds out the top 10. So what do institutions focus on? Liquidity depth, the ability to get in and get out without severely impacting the price. And if they want to make $1 million investment, they want to make sure that that $1 million isn't going to wreck the price. But what we see is, even in highly liquid environments like Bitcoin, there can still be huge volatility, especially with all the electronic algorithmic trading that happens. We see cascading effects when a whale, which is a wallet that has a lot of coins in it, when a whale decides to unload a lot of a coin, the selling pressure will bring the price down. But with all of the algorithmic trading that's going on, when that price starts to dip, sell orders may automatically kick in, and you may see a cascading effect where the sell pressure continues to build and build, driving the price down and down. And I think that's what we saw on Friday. But from an institution's perspective, long-term investing, they are still looking for that liquidity depth. That's one of the things that they focus on. Regulatory clarity. This has been one of the things that has stopped institutions from jumping in until really last year, when BlackRock established the first Bitcoin ETF. And now that we have an administration that is pro-crypto, and we see the passage of certain bills providing regulatory clarity, you're going to see a lot more institutions allocating a percentage of their portfolio into crypto. Network stability. This is very important. So the coin's ability to withstand large trades, to withstand large volumes, um, to withstand cyber attacks. Um, and that stability is really proven over time. And so when you look at the top 10 coins, they've been around for years, and they've have I have patched whatever vulnerabilities that they may have had. And so their network is much more stable. Um, Developer activity. This has to do with the number of dApps that are being developed on those networks. And are they actually solving a problem? And so for the ones that are providing the financial rails for the digital economy, we know that's about moving money faster and cheaper. But then there's other developer activities like for Solana, and one of its big applications, Pump.Fun, it was the easy creation of meme coins. And that helped propel the activity in Solana and made it the number one platform for creating meme coins. But now we've seen some of that activity shift over to BNB. And so it's highly fluid, but that developer activity is what institutions are looking for, the vitality of the ecosystem. And then one of the most important things for institutions are the custodial solutions. What are the ways that it can hold the token that are secure? And a lot of this is what they call institutional grade custodianship in third parties who all they do is build bulletproof ways of holding coins, multi-sig wallets, cold wallets. Again, this is not for trading, but this is for holding long term. And so institutional grade custodial solutions is another thing that institutions look at. So we've gone over some of the retail pitfalls. Chasing hype is probably the biggest one. This is the meme coin craze of chasing the coin, and it pumps for one day, and then within the next 72 hours, there's a rug pull, and the last ones in wind up losing money. Ignoring fundamentals. You need to look at these crypto projects the same way that you would look at investing in a company. The white paper is simply the business model. And you got to ask yourself, does it make sense? Does it have a path to profitability? How is it making its money? How is it creating its value? Emotional trading. When you're investing for the long term, you want to take emotion out, you want to take the timing out, and you don't want to trade, you want to invest. And this is where dollar cost averaging comes into play. And you always want to have a strategy, right? Last week we talked about, investing in gold and what type of strategy you should have with gold, and what portion of your portfolio should gold be. Well, the same with crypto in general, right? You should have an overall strategy of what percentage of your portfolio do you want crypto as a whole to make up, and then what percentage of that is in altcoins. Managing risk, diversification, of course. And so this is why We're looking at the top 10 um, coins by market cap. We've talked about hedging strategies, um, on-chain monitoring. All the data analysis that you need is online. And you want to look at um, open interest by options traders that usually infers sentiment. Um, but all the on-chain data is there. And then remember, capital preservation. That's what institutions, um, they would rather pass up 100 deals than to, look for that one deal that meets all of their criteria and checks all of the boxes. Um, so we're not swinging for the fences. They're doing long-term investing. So here are, again, some of the key metrics that institutions monitor on a daily basis. We've talked about on-chain metrics. You can look at active addresses, transaction volume, um, funding rates. This has to do with options tradings, and the funding rate will let you know whether the market is bullish or bearish based on the funding rate being positive or negative. And then whale activity. We've seen this really this year where we've seen some whale wallets that have been inactive for more than 5 years become active and start to sell off. And those whale wallets impact price, right? But specifically with Bitcoin, what we've seen is Bitcoin's price has been able to overcome even the selling pressure from the whale wallet selling. And so, and volume trends, especially ETF inflows and outflows, right? ETFs is what's driving this market right now. And with more ETFs coming on for different types of altcoins, you're going to see more institutions dipping their toe into investing into these different altcoins. So how do you build a smarter crypto portfolio? Again, I believe that you should focus on those coins and those networks that actually provide utility. You want to look at how a project is governed. You want to make sure that there's not the ability for a rug pull. You want to see what other types of partnerships does a project have. Who are they coordinating with? And then you want to analyze the ecosystem strength. All of the top 10 coins that I went over have very strong ecosystems. And so that wraps up the presentation. And as always, I want to invite those that currently are not members to join the CPIN community. We're built on 3 pillars. The first is we're built on community, a community of like-minded people that are practicing cooperative group economics, where it's not just about one person maximizing their profit, but it's about maximizing the benefit of the community. The second is education. And so we have education forums like the Let's Talk About It discussions that we have every Sunday at 5 p.m. on the West Coast, 8 p.m. on the East Coast. We also have a knowledge center where we have educational courses that focus on finance so that you can become better, well versed in finances in order to make better financial decisions, and especially how to manage risk. And then the third is investments, where we curate investment opportunities that allow our members to pool their money together and to invest in investment opportunities that they typically wouldn't either be eligible for because they're not accredited investors, or because they don't have enough capital. And so the CPIN community, I will put the link in the chat. Give me one quick moment to do that. But in the meantime, that is the presentation. And now is the time to open it up for questions, for comments on what you guys thought about investing in the top 10 cryptocurrencies the way that institutional investors do. Questions, comments? Anyone?
I would say, Mike, love the presentation as always. And I think what's good about this for the audience is resistance is futile for people who understand Star Trek, right? I'll be 60 next year. And one thing I'm very aware of is I've lived through an entire technology cycle. And I'm blessed to have energy, vitality, vision, and vigor at this stage of human history. We're at the front of the internet on steroids because it captures value. Still way early. So to have someone like Mike, who's willing to be that subject matter expert and to offer channels for us to participate, or at least have a trusted voice that we can lean on and eventually work with, is invaluable at this stage, because many of us aren't doing the work he just demonstrated. But since we have someone in our community that's doing that work, we should be supporting it and really be starting to think about, okay, how do we leverage the person in the community that's taking this responsibility, giving us this excellent data, and is committed to create opportunities for all of us to put a couple of dollars to work. So again, my man, excellent presentation. I just want to toss that out to the community in general. The moment of self-pub, the No Backboard Basketball League has a blockchain project, full community. And I'm positioning it as a platform or a community for all of us to learn and have a project that kind of touches upon this. And just by being involved and participating and making an impact in the community through sports and rewriting a different narrative, we all learn. And then that can be applied to all of our personal other areas. Because in 5-10 years, this is going to be the new reality. So again, thanks.
Thank you, Mark. Thanks. Leroy, you had your hand up.
Yes, I am so happy that we've gotten to this topic. Um, I spend a lot of hours a day working on this, so I really appreciate your presentation that you have made tonight. It's very clear. Um, you mentioned the whale activity. Um, I have spent a lot of time over the last 3 weeks or 4 weeks studying the thinking of whales. and how they set up their strategies, how they make decisions or whatever, and how they move markets, and actually how they set up in a way, as you talk about liquidity, so that for the uninformed, the sometimes retailers that are not as informed, where they sort of chase themselves up and chase into a trap going up and then coming back down. Well, whales can have do certain things that can get the attention later of the retailer, and then then the retailer jumps in and chase it back down. I better get out of panic and all of this. So I have looked at two major indicators that point out what whales are doing secretly, privately, quietly, behind the scene before the retailers recognize exactly what's happening and join in. And so there's a paper that I'm working on, how to think and trade like a whale.
Hmm.
And it's quite of interest. I had some trainers working with me on some things, and of course, they had all of the technical analysis and things of that sort. But there was that one little piece that they were missing, and that is how do you look behind the scene and know exactly what a whale is doing at a certain time that they are accumulating. It doesn't look like anything is happening with the price or anything of the sort. They have their own strategy for doing that. And then all of a sudden, you see the price go up or the price come down. I'll just stop there. But I just want to say that how much I appreciate this presentation on tonight. It is very helpful. And I'll stop there.
Well, I definitely am excited to see what your conclusions are from your paper um, about um, about whales and the clues that they give to their activity. Um, and this was meant, as always, just to be a broad overview. Um, as always, um, we can go deeper into specific topics. But this is just a broad overview, really to get you as a retail investor to think differently and to think like institutions. I think it was a couple months ago where I said, to go all in on Bitcoin. And the number one reason, follow the money, right? Institutions were dumping, billions of dollars into Bitcoin ETFs. Um, and so the thing about institutional money, institutional money is like a battleship. That's the power that it has. Okay. So you want to follow that battleship. But when that battleship, but it takes a lot to turn that battleship. Um, and so when you are following the money, you can do your data analysis and you can see when the sentiment is changing. So, for example, in the last couple of weeks, there have been some whales, large wallets that have been dormant for 8 to 10 years in Bitcoin that suddenly became active and sold off some Bitcoin and bought Ethereum. And so we see there's a change in sentiment in some of the larger institutional money shifting toward Ethereum now. And we also can see this in some of the newer ETFs that are coming out and the newer projects, right? And so, but we have to be careful because those newer projects have a lot greater volatility. Yeah, they do have a greater opportunity for price appreciation, but they also have a greater opportunity for risk. And so, as always, it's based on your risk tolerance. It's based on how long your investment time frame is. But you know, if you've got at least a 5-year time frame, I think you need to be overweight on crypto, um, and look at, you know, spreading that out among those top 10 coins and investing in the long run. So, for example, if you had been a long-term investor in Solana from when it hit its lows in 2022 of $30, it's now trading at, what is it? It should be close to $200. I know it did dip over this weekend, but everything dipped over the weekend. Um, but um, but these altcoin networks are proving themselves, and there continue to be new networks that spring up. I've talked about Athena. I've talked about was it hyperlink, um, and so we just need to keep an eye out, do your due diligence, and it's all about risk management um, in the end. Jeremy, did you want to say something?
Oh no, I was just I was just going to confirm that with Solana, I think it had reached to like 214. It's knocked back down to 196 a share or a coin, but yeah, it was up to like 214 from $30.
Yeah. So you know, we with AI allows any retail investor to invest like an institution, to do the data analysis, to put in the risk management strategies. And so the only excuse for not doing it is ignorance, not knowing. And so I hope that this discussion has given you some information and insight to how institutions invest, and hopefully that can shape your own investment strategies when it comes to crypto. Anybody have anything else to say on this topic? Okay.
I just want to ask one question since I didn't hear anyone say anything. Looking at CPN, BPIC, um, uh, the structure that is being unfolded, and looking at these 10 cryptos, top 10, looking at the strategies that have been mentioned, the important things. So this will end up being one of the wings, components that individuals can engage in, similar to the other 6 or 7 or 8 possibly that's already been? How do you see this structured in?
Yeah. So we actually offer a crypto staking investment opportunity to where you can pool your money together with other people, and then the BNIC takes that money and invests it in these top crypto platforms for long-term appreciation, as well as generating some cash flow through staking. And so staking is unique to crypto because it basically says I'm going to tie up my coins, not be able to sell them, but in exchange for that, I'm going to receive interest, and usually in the form of the same token that you're staking. So if you're staking Ethereum, you'll receive your interest in Ethereum. If you're staking Solana, you'll receive your interest in Solana. And so if you're holding for the long term, and you're not exactly sure which coins to invest in, we give you an investment opportunity where you can start with as little as $100, and we do the homework for you, and you get a preferred ROI. I think I can't publicly say what that ROI is, but it's an investment opportunity that is listed in our members only platform. So if you're a member, just log in under investment opportunities. I think it's number 5 or 6. It's the crypto staking platform. And it goes and provides all the details of what the preferred ROI is. And the preferred ROI just means you get 100% of the profit up to that ROI, and then anything above that amount is split 50-50 between yourself and the BNIC network, which is the managing partner. And for those that aren't a member, you can join for free. The link is in the chat. And so, check it out, become a member and check out the investment opportunities. There's no obligation to invest. And then you also have access to all of the educational courses. But yes, we have an investment opportunity that implements this buy and hold strategy in the top crypto currencies. Any other questions, comments? All right. Well, not hearing any. Don't want to keep you any longer than is necessary. I want to thank you guys for coming out here on Sunday evening, spending about an hour of your time taking part in this discussion. We're here every Sunday, 5 p.m. on the West Coast, 8 p.m. on the East Coast. We have a different topic each week, and I invite you to invite at least another person who could benefit from this discussion. So with that, stay blessed and stay safe until next time. Bye-bye.